Hi everyone. With the tax filing deadline behind us, Andrew and I thought it might be helpful to send a quick video kind of going through the front page of the tax return and a few schedules just to help point out a few things that typically affect most of our clients. With CPAs being human, with CPAs being busy, it's very possible that there could have been a miscommunication or a typo or a mistake. Already this tax season, just in the last couple days, I found where an IRA charitable distribution wasn't coded right, another tax return where all of the charitable gifts that should have been on Schedule A did not add up. And so it's important to try to review your tax return and understand where the numbers are coming, because no one's going to care more about your money than you. So this is really just kind of an overview video of the things to try to take a look at and understand. One thing to note, your tax return really is just a big math problem, taking all the information of your income and expenses and deductions from the calendar year and computing what your tax bill is compared to what you paid in along the way. So, Andrew, what is the 1040?
So the 1040 is just the number the IRS uses for your personal tax return. And the 1040 is usually 2 or 3 pages where it has all the numbers consolidated from all of the tax pages that you'll see on your return, and it shows income, deductions, tax payments, credits, and then eventually at the bottom, a refund or what you owe. Yeah, so the first 2 pages of the 1040 are the summaries, and they may then guide you to the schedules that have the details on income and deductions, and all of that flows back to the 1040. So John, start us out. We're going to go through some of the important line items on the 1040. We want you to be able to understand how your taxes are prepared and how those line items are calculated. So John, what is line 1?
So line 1, there's several parts to line 1, A, B, C, D, E, F, G. Most people are going to see something on line 1A, and this is your wages from your company. This might be a combination of you and or your spouse's wages if you're filing a joint tax return. And a lot of times there's a wage report farther down in your tax return where you can actually see the breakdown of those numbers. This comes to you from the tax form your employer gives to you. It is a net number of any pre-tax contributions withheld from your paycheck. So it's good to make sure that that number gets in there correct, because that's probably your biggest income source.
And what are the typical withholdings that then get you to the net W-2 number?
Could be a pre-tax retirement account contribution. It could be an HSA contribution, other company benefits. But yeah, you'll see that there's a taxable wages line. That's after your pre-tax numbers are deducted. You'll also notice there's a Medicare line showing what your Medicare wages are. That is essentially your gross earnings, because Medicare is charged on all of your income, whereas Social Security, you may see another number because there's a limit on how much of your income can be taxed for Social Security purposes. What about line 2?
Line 2 is interest paid to you during the year. So usually this is derived from interest that a bank account pays. Now, for the past decade plus, that's been very minimal, so you may not have even received a tax form from your bank. But as rates are going up and as banks are paying more, you'll likely receive a tax form for the interest paid. It can also be from interest that your investments are generating. And line 2A is usually from dividends paid from municipal bonds. So that's tax-free interest, but that's where it's reported.
Moving on to line 3, this is your dividend income. A lot of the times this is from your investment account, like TD Ameritrade. If you have a non-retirement account, a lot of people have accounts at ComputerShare or any other custodians. Some people still have stock certificates and get the stock form, the tax form directly from the company. I had one client that had about 15 of those, and we brought it all into TD, so they only got one tax form. Something to keep in mind if you're in that situation. Qualified dividends, you'll notice that is 3A. Qualified dividends are dividends that qualify for special tax treatment, essentially capital gain tax treatment. There's some restrictions around there. Usually it's U.S. companies. There's kind of a holding requirement, how long you've been invested in it for it to qualify for that special tax treatment. But yeah, we'll bring up an example of a TD 1099 because TD for non-retirement accounts issues what's called a consolidated 1099. And so on this one form, there is a lot of tax forms kind of getting summarized from TD Ameritrade, including for interest, included for capital gain, like if you bought and sold investments, as well as the dividend information. So that's something to know, that your TD tax form may affect multiple lines of your tax return.
Next up, line 4 is IRA distributions. So if you have pulled money out of your IRA, it's likely going to be taxable as income. Now, there are some exceptions to that, but if you don't withdraw until you're after 59 and a half years old, you don't pay any penalty. You're still going to have to pay tax when it comes out. Then there's the required minimum distributions when you reach, well, they just changed the law, but it used to be 70 and a half, then 72, 73, it will be 75 in the future. That's when you're required to start taking money out of your IRA. There may be a difference. So you'll see there's 4A and 4B. Even though money came out of the IRA, it may not be taxable. For instance, if you had a 401k rollover, they're going to report the rollover as a withdrawal, but it won't be taxable if it went into another 401k or IRA. If you gift from your IRA directly to a charitable organization, what's called a QCD, Qualified Charitable Distribution, that's going to show as a withdrawal, but it won't be taxable. So it's that number on 4B that will actually add to your taxable income.
And again, you may have multiple 1099-Rs showing these distributions. If you've got multiple IRA accounts, you and your spouse, maybe you did a rollover as well. Again, usually there's a schedule further down that even gives you the breakdown there of what the company was, what the distribution amount was, how much of it is being reported as taxable.
And also if you elected to have income tax withheld when you took the distribution, kind of like with your paycheck, if you have tax withheld, often we will have clients that want to withhold tax on the front end so there's no surprise when they go to file their taxes.
Line 5 is taxable pensions and annuities. Basically, what payments did you receive from a pension plan or an annuity investment? Again, there's a kind of a gross line as well as a taxable line. 5A is your total payment. 5B is the taxable amount. If you see a difference, it's important to understand why that difference is there. Annuities a lot of times have what's called an exclusion ratio, where the full payment is not 100% taxable to you.
Line 6 is Social Security. And again, you've got 6A, 6B. 6A being the combined gross Social Security, either for an individual or for a couple. 6B being the taxable amount. So it gets a little nuanced. Social Security, you may not pay any tax on your Social Security payments. You may pay tax on up to 85% of the Social Security payments that you received. It's based on your total income. So that will be computed when you enter all your other income streams as to the amount of your Social Security benefit that is taxable for the year. All right, let's see. John, we're at line number 7.
So line 7 is your capital gains, and this comes from Schedule D. So if you pull that schedule up, so capital gains is where you've bought an investment, held it for a period of time, and sold it. And either when you sold it, you got more than you invested or you got less. So you either had a capital gain or a capital loss. And if that investment was held for less than 12 months, it's considered short-term. And short-term capital gain is taxed just like ordinary income, whereas if it's long-term, you get more favorable tax rates on that gain of that investment.
Sold after a year.
After a year. So if you're at day 364 and you're thinking about selling, you might want to hold on for another day or two. You'll get better tax treatment. And yeah, capital gains actually net against each other. So they'll take all of your short-term, add them up together. You'll take all your long-term, add it up together. Those two will actually net to each other and then flow into what is on that capital gain line on the front page of the 1040. It's also important to note that if you have a overall capital loss, you can use 3,000 of that loss every single year just to subtract from all of your other income. And say you had 10,000 net loss, you use 3 this year, you will carry forward that other 7,000 into future years until it is completely used up.
Line 8 is also known as the Schedule 1. This is kind of a catch-all. So the Schedule 1 flows over to line 8, but this can be all the other income streams that don't fit on the first page of the 1040. So usually that's going to be if you're self-employed, it'll report your net self-employed income, which will then come over to line 8. If you have profit from a business, if you have rental income from an investment property, if you receive a K-1, if you receive alimony before, let's see, if you were divorced before, I want to say 2018.
Somewhere around there, I'd have to look it up.
Yeah, the laws change there. But that's where everything is compiled on Schedule 1. It flows over. There's also, in addition to the income that flows over, there are deductions that show up on Schedule 1. So if you contribute to an HSA outside of your employer, if you make an IRA contribution that's deductible, if you're paying self-employment tax, you get to deduct a certain portion of that. If you're self-employed and you're contributing to a retirement account like a 401k or SEP IRA or solo 401k, that also is a deduction. And then if you're self-employed, your health insurance premiums are deductible. So all of that is on your Schedule 1. We're going to pull it up, and then that comes over to line 8 on your 1040.
And that's another thing to pay attention to, because some CPAs are used to putting the insurance premiums on Schedule A, but if you have that self-employment income, you want them to go against that income, because Schedule A, we'll get to that in a second, but it could be phased out or you may not get any benefit of that at all. But yeah, Schedule 1 was basically how they reworked the tax form where they could get all the information on one page. They just took some stuff off and created another schedule. So it was kind of a gimmick.
Yep, that's right. And we're skipping ahead, John, to line 11.
So line 11 is very important. This is your adjusted gross income. So it's all of your income sources less some of the, what we used to refer to as above the line deductions, because the AGI used to be the last line on the first page of the 1040, then you got to the second page. So still they're referred to as above the line deductions a lot. But you really want to understand this number because it affects many things. Like I mentioned a second ago, if you have medical expenses on Schedule A, there is a phase out based upon your adjusted gross income number. The AGI number can help dictate whether you can make a Roth contribution. They actually look, I believe, at modified adjusted gross income. So it's this number maybe with a few other things added into it. And Medicare premiums. If you're receiving Medicare, there's something called IRMA, the income related monthly adjustment amount. That's basically where you pay a higher premium just because you have more income. So you want to know where your AGI line stands for multiple reasons.
Line 12 is the standard or itemized deduction. So you've kind of compiled all your income up to the adjusted gross income, and now we're going to start looking at what reduces that taxable income. So everyone receives they receive the higher of the standard deduction or itemized deductions. Now, several years ago, they doubled the standard deduction. So a lot more folks who file are taking the standard deduction than they are taking itemized deductions. For 22, it's about $13,000 for individual, $26,000 for married filing joint. So that's the number that the IRS gives you, unless you itemize. What are the itemized deductions? They go on Schedule A, which will pop up here. And the primary deductions on Schedule A are medical expenses, as John referenced. It has to be medical expenses paid out of pocket over 7.5% of your adjusted gross income. I know that's a lot, but you'll see on the Schedule A, they have the calculation there. Tax, so income tax, if you're in a state that has income tax, property tax on your real estate, sales tax, so you either get your state income tax or sales tax. In Tennessee, you're going to take the sales tax because we don't have income tax at a state level. Your mortgage interest, so the deductible amount of your mortgage interest, and then the last being charitable contributions. So you add all of those up. If you're an individual and they're less than $13,000, you're going to take the standard. If they're more, you're going to take the higher itemized deduction. Same with married filing joint. Over 26, itemized. Under 26, you get the standard. So that's how all of that works.
Also, if you're over 65 or blind, you actually get an additional standard deduction.
That's right.
Which is a nice little add-on. So this all brings us to line 15, which is your taxable income line. So we've listed all of our income, we've had some deductions in one place, we've now gone through the Schedule A deductions. This is the number that really dictates your total tax bill. It's your taxable income. And so we have what's called a progressive tax bracket. We've talked about that in some other videos where, whatever your number is, you'll see that corresponds with a tax rate, 12%, 22%, 24%, 32%. Just because that number is in that percentage line, that doesn't mean all of your income is taxed at that. You get the benefit of paying a certain amount of tax at 10%, and then you progress into the 12% tax brackets. You also have to understand that this taxable income number, a lot of it is ordinary income, but it also may be capital gain. And so those can kind of play together as well. Or say, if your income was $100,000, but 5 of that's capital gain, well, 95 is subject to those progressive brackets, which could include some of your capital gain. Capital gain can be taxed at 0% too, depending upon what bracket you're in. But taxable income number is really the bottom line. This is what your tax bill is being calculated on.
And your tax return, some of it, you have your tax forms and your W-2 and it goes in and you have no control over that. But the whole goal is to reduce your taxable income. And there are strategies that you can take to do so that your CPA may not suggest to you, like a IRA or SEP contribution, like an HSA contribution. So things that you can do before you file your tax return to lower your taxable income, which then lowers your tax bill. So that's why it's such an important base number, because it dictates the tax that you're going to pay. Which takes us to line 24. And this is at the top of page 2 of the 1040, at the bottom of that first section. This is the tax that you will owe for that year. So we're looking at the 2022 tax year. The total tax includes federal income tax plus self-employment tax, less any credits that you may have received to reduce that tax. And a credit is different from a deduction. A deduction lowers your taxable income. A credit reduces dollar for dollar your tax. So you'd rather have a credit than a deduction. The most common credit being the child tax credit if you have minors. But line 24 that's your tax bill. That's not necessarily what you'll pay out of pocket when you file. That's the tax that you owe for that calendar year.
The next section shows all of your tax payments that you made throughout the year. Line 33 is where it adds up the total payments, but these payments could come from a variety of ways. I mean, if you're a W-2 employee, it's the income tax that was withheld from your paycheck. If you're on Social Security, you may have elected to have Social Security tax withheld from your benefit. If you take money out of an IRA, you can elect to have taxes withheld on your behalf there, or estimated payments too. I want to mention that if you're making quarterly estimated payments. So a lot of times people ask, do I need to make estimated payments? Well, it just depends. Like, what is your tax bill going to be, and how much are you having withheld from other sources? Because somebody might have a recommendation to make an estimated payment, but they're not having tax withheld from their Social Security. Great, we can just go have tax withheld from your Social Security. It'll take care of it.
Or if your income is going to be lower next year, you may not need to make the same estimated payments. That's just the recommendation when you file your taxes. So this takes us to your refund, or the amount you owe. So refund, line 34, amount you owe, line 37. No one wants to owe. Everybody wants a big refund. If you get a big refund, it means you gave the government a loan over the course of the year. So the goal really is to get to the zero.
A loan that you didn't get interest on.
That's right. They're not paying you interest. So if you come out to zero, that means you paid in the exact amount of tax, you didn't give them a loan. So that refund, or what you owe, is it looks at the total tax owed versus total payments, what John was just referencing. You can apply an overpayment if you paid in more tax than what you owed on tax. You can apply that to the next year. A lot of folks like to do that so that it kind of gets them ahead for the next year, so that they may not have to make that first estimated payment. But the other thing about owing versus getting a refund is, would you rather have more dollars in your pocket throughout the year to invest, and you think you could then grow that money, or would it be better for you to have a forced savings, which is really what a refund is? It forces you to oversave to cover your tax bill, and then you have this refund to, again, we would recommend investing the refund once it's due, but you have this bucket of money that then is paid back to you.
Yeah, I mean, a lot of people like just to have that kind of nice surprise when they file their tax return, because it's some money they weren't expecting or weren't thinking about, at least. The final thing we wanted to mention, though, is there's marginal versus effective tax rate. And this was a little bit to what I was alluding to with the progressive tax rates. So marginal is the highest bracket that your income fell into. So maybe you had $5,000 that was taxed in the 32% tax bracket. Would have been great if you could have found a deduction or did a retirement contribution to get you out of that 32% bracket. Effective tax rate is essentially how much tax, the total tax dollars you paid over your total income. So, I was looking at one earlier today, somebody effectively paid 8% of their income, whereas, that person was retired, but other people working might be 22 to 24, or higher. It just depends on all of the variables that are going into your tax return. So,
in most of the tax software, it has a page towards the end where it shows kind of a breakdown of all your income, deductions, tax owed, tax payment, and then it'll show your marginal rate, so that top tax bracket that you paid in, and then your effective rate, which, as John was saying, is the blended rate. It's your true tax rate that you paid on your income.
We hope you found this video helpful, and feel free to share it with any friends or family members, and look forward to sending some more helpful information in the future. Thanks for watching.